watching. So for now, I'd like to welcome Olsen Adams, who's the founder of Whetstone Research, to the stage.
Oh, baby. Thank you, thank you. Can you guys hear me? Okay, perfect. I can hear myself, so now I'm like, I know it's good. Hi everyone, I'm Austin. I run a company called Whetstone Research. This is a wonderful little, my opening slide. At Whetstone, we build protocols that try to sort of like innovate on market structures. So our main protocol is called Doppler. It's a liquidity bootstrapping protocol. We do token issuance mainly. With this token issuance, we're mainly focusing, we do the token issuance for like Zora and the Base App and FX Hash and a lot of other sort of like these publisher exchanges that want to bundle together token creation with sort of like the distribution of content mostly. So how do I go to the next slide? Is there a clicker? Or do I just tell you guys? Oh, perfect. I was right here, perfect. All right, sorry about that. Okay, perfect, yeah, so the talk is called Skeuomorphic Markets. I think I'm gonna say the word skeuomorphic probably more times than anyone should probably say in one talk, so this will be fun. I said there should be a poly market for how many times I say skeuomorphic in this talk. It's probably gonna be like 15 or 16. So the first thing I want to do is I want to define what a skeuomorph is. This is the Wikipedia definition, which is the sort of like idea that these derivative objects are like improvements in new technology or new ideas, sort of like retain these features from previous ones that are sort of like ornamental in design now. And so this is sort of a nice Wikipedia definition, but here's a few examples of them. So you can see Apple is very common for using skeuomorphs. They love to do them to help users have some sort of continuity in their ideas where, if you want to make sure that for the telephone app on your phone, you can sort of like see there the telephone app doesn't make a lot of sense the way that it's done today, but it made a lot more sense back then. So this is an example of a DJ mixer, like an electronic DJ. They have knobs and things like that. Those things they're not necessarily needed, but they're helpful for users to have some continuity in their design. There's a nice electronic candles that maintain the design standards that are sort of were previously required from the design but are not anymore. And so why do these skeuomorphs exist? It's mostly that it's just really hard to build new things, and you have to make a lot of choices when you're building new things. And sometimes you're just I'll do what works. And so this is sort of the king of skeuomorphs. He's the guy who designed all the software for the iPad and the iPhone. And so he's sort of the man who always talks about these things. And yeah, so I sort of talk about here that it's really hard to know that these changes you're making for your designs or the future iterations of your product, if they're actually efficient, and even worse, it's harder to know that when you do make these changes, you might lose efficiency or attrition your users out of these things because the changes might break sort of the user's understanding of these things, and even worse, a lot of companies don't really want to innovate on designs when things work because no one really wants to innovate unless they're really sort of forced to. This is sort of traditionally known as the innovator's dilemma. So this is actually what the talk is about, which is skeuomorphic traditional financial markets. So skeuomorphs are really, really common in financial markets. We see these all the time. Pretty much every single financial innovation has these skeuomorphs where they start out with the example that I want to talk about is stock certificates. So stock certificates used to be literal stock certificates that you would have in your hand. You would, if you had those stock certificates, you were the one who was, you could guarantee, you would be the one who owned those things. And what happened was the changing of paperwork was so complex that they said, okay, what if we take all these stock certificates, we put them in one little room and we don't let anyone else move them? And then that's the DTCC. And then what happened was we said, okay, what if instead we just put all these stock certificates on the internet and we actually got rid of them entirely? So those are the skeuomorph is the idea of sort of like a stock. Like a stock certificate used to be this piece of paper that you held in your hand, and now it's nothing really more than an entry in a ledger in sort of like a government institution. And this is similar for like bank reserves. This is similar for trading, where trading used to be done in open outcry pits in these exchanges, and now it's like mostly really only done on electronic exchanges. So like, why do we care? Who cares about all these things? I think like one of the things that I think a lot about is that these skeuomorphs really come through when you're doing innovative things, because you sort of question like, why were these decisions and these previous ideas kept around? And the thing we're going to really be talking about today is skeuomorphisms in IPO markets. So I think IPOs, in the way that they're really done today, is one of the larger skeuomorphs in the market. The form factor of the IPO really hasn't changed in almost like 500 years. So the original IPOs that were done by like large investment banks and they're done in like the Netherlands have functionally been the exact same design as how they're done today. And back then, it was like significantly harder to do these initial public offerings. So you would have to get together a bunch of banks. You would have to they had to put up like this monstrous amount of capital, and these IPOs were huge undertakings, but now they're not really as hard as they used to be, and we can sort of like see how they should evolve. So the IPO market is like something that I do a lot of research on. It's been functionally dead for around like 30 years now. The number of IPOs that happen each year has pretty much only been declining. There was a huge jump in 2021 when the post-COVID, but since then it really hasn't recovered. Even worse, the IPO quality, so the average quality of the assets that are IPOing is significantly worse. Most assets that are IPOing today are actually losing money. So it's like actually a bad stock to buy, and they're mostly technology stocks these days. The IPO market did open in 2025, so we saw a bunch more than we generally see. But of these IPOs, the vast majority of them were actually crypto and AI companies. So it was mostly just like these like vaporware technology companies. And there still was significantly fewer IPOs than people expected because the IPO window closed sort of like in Q3 and Q4. And the ones that did happen, the IPOs that happened, like the Circle IPO and the Figma IPO, were actually quite bad. They were like massively underpriced. They left a lot of money on the table, and the sort of outcomes have been pretty poor. And so pretty much like we've had the best IPO market in the last, this year was like the best one in probably 5 or 6 years. And of those, it was mostly technology and AI companies. And of those, the biggest ones were bad. So it's like, what really is the problem with the IPO market? The problem with the IPO market is that it's gotten worse in probably almost every single way. They're significantly more expensive. They're significantly expensive to do, both like through regulatory, the time it takes to do the regulatory work, and the time that it takes to actually undertake the cost of getting your IPO priced. The economy has changed very drastically over the last 30 years. So this is something that I write a lot about. Generally what happens is companies want to stay private significantly longer than they used to. So like, for example, Amazon went public very quickly, almost a year into their life cycle, because companies just used to go public a lot earlier than they used to, but companies wait a lot more now, and this has downstream impacts to the IPO market. Another one is that the benefits for IPOs are much worse than they used to be. So companies would IPO because they wanted the marketing benefits from it. So they wanted to get their name on the big stage. They wanted to be seen as a big company, so they would IPO. And that's just like really doesn't happen anymore. People only really IPO at the end of their life cycle. And I sort of see the last one as similar to why a lot of tokens are issued today. Like a lot of tokens are issued as marketing, actually. And they have the same benefits as a lot of these early IPOs. And so the other one is that, the private credit has mostly replaced the IPO. So the IPO has been mostly replaced by venture capital and private credit. So the vast majority of what would have been done through private credit is done through these venture capital funds now. The amount of private credit has pretty much been up only. It's been the best returning asset of the last 10 years. Similar to how venture capital was the best performing asset of the 2010 or the 2000s and 2010s. And the problem with this is that private capital creates a two-tiered financial system, which I think is the really big problem with this, is that there are, you either have access to these deals, these private deals, or you don't. And this has really created the problem where the public markets don't get access to deals until late in their life cycles, so the regular people never have the upside in this. I say here that like everyone's really, these things are not malicious per se. They are a natural consequence of sort of how these markets have evolved over time. But there's a lot of second order effects from how these markets have evolved. So there's a ton of papers on like how do we improve the IPO. I read a lot of them, and the answer is like no one has any idea. We have no idea how to fix the IPO. We functionally think it's a dead market. There's regulation that was tried early on in the Obama era. The Jobs Act tried to improve the IPO. It had a very small benefit, and it sort of didn't work. There's been attempts at the market structure benefits of IPO, or to fix the IPO. Those haven't worked either. The underwriters have been centralizing. There's fewer and fewer IPOs every year, done by fewer and fewer underwriters, and it consistently concentrates these things. And sadly, the alternative paths for crowdfunding and direct public offerings have had no uptick. And most of them are seen as like an adverse selection factory. So all this is to say that like no one really has any idea how to fix these things. They're kind of just trying their best. This is a wonderful slide from Alana at Variant. And so the one thing I want to put up here is to highlight that we sort of see these synthetic assets like these X stocks and these Robinhood tokens and sort of also this Galaxy token as these skeuomorphic stocks. They're pretty much the exact same thing we have today. We're putting them on the chain, and they really just come with all the same problems. They don't solve the underlying problem of how these assets get priced and get moved on the chain. And so we really will think about focusing on this final area where it's sort of this native asset issuance is sort of bundled on the chain, exclusively on the chain. And that's, she has it open for innovation. We hope to be part of that innovation. And this is my belief. This is sort of like the things I'll harp on for the rest of the talk. The traditional financial markets are like very much underserved to the public. And it's mostly due to skeuomorphic artifacts of how these things evolved over time. So like IPOs used to be this massive undertaking that was so difficult for people to do, and now it's pretty commoditized. There's a few investment banks that do them all the time, and it has sort of like created this two-tiered financial system. Worst off, the public really has been locked out of asset creation. You only really get them, the public is only able to access these financial markets once they have IPO. The longer it takes to IPO, the less upside there is for these financial institutions, so we've sort of locked them out of them. I argue here that like the functional banning of early companies from going public has led to the retail getting locked out of generational wealth. There's so many stories about people in the 80s and the 90s during the tech boom and through the IPO boom of people making generational wealth for themselves because they bought some stock early that they believed in, and that led to their family having a lot of money. That's just not possible today. The only way you can have access to these companies is by being an accredited investor, and being an accredited investor is like actually surprisingly very hard. We need to sort of move past these design decisions, and we need to build these markets that are uniquely enabled by today's technology. So here's what we can do about it. This is sort of like what we think about it at Whetstone of like how can we build a better system for asset issuance. So we think about like automated asset issuance, public underwriting, and long-term liquidity management. These are three things that we'll go into. But we also sort of think we need to make the IPO more valuable to companies. They're not very valuable to companies anymore. We need to make it happen earlier in their life cycle, and we need to make it easier to actually undertake. They're significantly hard to take. It's like a $50 million investment, more than that for a lot of these companies. So what does automated issuance means? So like tokenization, I think, is like the biggest example of this. Like if you can create a system that automates a lot of this issuance, what happens is it becomes significantly easier to both due diligence for investors. So investors have to check fewer things, and also it allows market standardization where you have one traditional type of market. You don't have to do all this diligence for all these things. So what happens today is these assets are created. You don't have to check the code. You can look at the pie chart. You can look at how all these things work, and it makes it much easier for people to do diligence. And we also think that issuance protocols that help with issuance they lower the barrier to entry for creating assets. So what this means is people who are not experts on creating assets, and they're more trying to create content, they're trying to create art, they can get a lot of the benefits of this incredibly powerful issuance protocols by utilizing automated issuance. And then finally, it removes a lot of the barriers to entry for getting listed on exchanges. One really hard part for exchanges for new assets is getting listed on exchanges. It's actually extremely difficult. And so we think automated issuance can improve those. Another one is market-driven underwriting. So today there's 6 underwriters. They're mostly mega investment banks who price all the deals, and they do all the liquidity generation for these events. And what has happened is they have responded to the change in the IPO market by doing significantly fewer but significantly larger. Did I get cut out? I might do. Okay. They've responded to issuance by doing significantly fewer but significantly larger issuances. They don't really care about these small ones anymore. And so what happens is these small companies have no one who's willing to do underwriting for their service. And this has created a problem where these small companies, it's not worth it for anyone to price these small companies, which has led to them not being priced, which has led to sort of this part of the market just being underserved. And then finally, we think that by using market-driven underwriting, you can allow the public, you can allow more people to take part in the underwriting process, which will allow people to have more upside in deals because they can participate in them earlier. These are sort of pretty unique to crypto. These are things you can only really do in these markets. Finally, I think one thing that people should harp on a little bit more is long-term liquidity management. So what happens once an IPO is done is you have to get an underwriter who will, you have to get a market maker who will provide the long-term liquidity for your asset. One thing that's very interesting about the long-term liquidity management and issuance protocols is these two things are bundled together. So what happens is the market underwrites them. Some of those proceeds or all of those proceeds goes into an automated liquidity management protocol, and that allows you to sort of bundle these two things together that have historically been apart, and allows you to have a public market that's well priced long term. One thing that's been interesting for us is that pretty much spreads have not decreased, especially for larger, for sort of smaller cap assets have had the same spread for a very long time. If you want to buy a small cap asset, it'll be 1 or 2% spread just to buy them. And we think that liquidity management protocols like AMMs and protocol and liquidity can lower these barriers because they can enable automated, make it automate a lot of these things, which is pretty unique to crypto. And so you can bundle these two things together that previously were unbundled. Long-term liquidity management and sort of the IPO in general. This is sort of the future state. This is sort of the things that I'm hoping for. So the first one is by lowering the fixed cost of creating an asset, we hope we can create new asset classes. And we've seen this with sort of the things that we work on with content coins and art coins and micro IPOs. So by lowering the barrier, the fixed cost required to undertake an initial public offering, you can enable new classes of assets that weren't possible or sort of priced out before. Experimentation with assets also allows you to experiment on these sort of small but meaningful changes. So what has happened is with other protocols, we've changed the price. We've looked at changing fees, changing vesting schedules, changing the structure of these things, and that has really impacted what assets and allows us to experiment and prod with these designs. Open up capital to more users and more people, so we can see things like micro IPOs or on-chain pricing rounds. And then finally, we hope that we can create the best structure for streamlining diligence for capital allocators. Today, it's very hard for you to know when you're buying a token, what does it mean? But we think that by creating automated diligence and internet roadshows, you can potentially make that significantly easier. This is our logo, the Doppler logo. And this is what we build. This is the Doppler protocol. This is what we think, hope that it does. So it creates standardization in market-driven underwriting, distribution, and long-term liquidity management for any type of initial offering. It was intentionally designed to be not skeuomorphic. It was designed from first principles to attempt to get the best possible, to create the best possible market for internet sort of native assets. This is our logo, and I guess I'll keep that up there while I do questions. So I got 5 minutes for questions, and happy to yap about them. Oh.
Thanks, Austin.
Of
I've got the
course.
questions right here.
Give me the questions.
Yeah. I mean, I'd love to yap here for a few hours, I guess.
You know, I love yapping with you as well, so.
We won't keep the audience too long, I guess.
Okay.
Okay, first one is, why are centralized exchanges so large in comparison to decentralized exchanges?
Yeah, I think that's more of just like a path dependency. So I think centralized exchanges were there before decentralized exchanges, and we have seen that like those, the amount of volume being done on decentralized exchanges is pretty much up only compared to centralized exchanges, and so the share of market volume being done by DEXs is pretty much up only. I think that eventually will flip. I at least hope it will, but it's not guaranteed. So I think the answer is more, I think it's a path dependency of just like how things have evolved over time.
That's a very optimistic answer.
Yeah, you gotta be optimistic.
That's good. Okay, the second question is, how does the market-driven underwriting functionally work?
Yeah, so how we use, and we have multiple auctions in Doppler, but one of our main ones, how it works is we have an expected amount of tokens we expect to sell per period. And if there's more tokens being sold than the protocol expects, it raises the price. And if there's fewer tokens that being sold than it expects, it decreases the price. So what it's doing consistently is based on the amount of marginal demand. If the marginal demand is what we expect, then we sort of keep the price stable. If the marginal demand is low, we decrease the price. And so this is sort of like how the market responds to the protocol's changes in prices. And that drives a sort of like gradient descent to like what is the sort of like optimal or correct market price through looking at marginal buyers and sellers.
Cool, that makes sense. Okay, then yep. One last question, which is, I see another one. So yeah, two more.
Of course.
How do you protect retail while allowing them to access assets earlier?
Yeah, I think, I do think it's really important to protect retail from scams. I do think that one thing that's really important is highlighting that fraud is already fraud, it's already illegal. One of the reasons why like the blue sky laws were put into place in the 1900s against stopping retail from taking part in these markets was because it was fundamentally impossible for the US government to keep up with the amount of scams. That's not true today. It's very different than it used to be. And we think that like one of the ways you can do that is through having good laws on like what really is fraud and pushing and attacking sort of like the bad actors in the space. We don't think you should be punishing good actors and stopping people from taking part in these things. We think you should be targeting bad actors. Like one of the reasons why we just banned everyone was because it was like the 1900s. There was no SEC. There was not even a single government institution, and it was simply just easier to like put your hands up and say, we lost this fight, let's just ban retail from taking part in these things. That's not how it is today. The internet has massively changed people's access to capital and access to new opportunities, and we think that like those things will help with protecting retail with like more diligence and more information about these things.
Okay, the final question is similar in vein. So the question is, do you think that the most promising companies will continue raising privately no matter what, and that whatever is publicly accessible early will always be subject to some degree of adverse selection?
Yeah, I think it's a good question. I think that like one of the things that is important to think about is like one of the reasons why people do private rounds is that it's like actually just more cash efficient. Companies get significantly better prices doing private rounds than they do on IPO markets. And I think a lot of that is just because of the structure of them. And so I think it's very important that we create a system in which it is economically viable to compete on with these private rounds, and I think that by opening up capital to more people, we'll get better prices and better outcomes for these sort of like smaller cap tokens. And I also hope that by opening it up to a broader audience, we'll also enable like more marketing, like these sort of second order benefits past just prices. Like what we've seen with a lot of tokens is it generates like a very good holder community, people who believe in it, people who give good responses and take part in these things. And we think those are the more second order effects of having a public asset.
Okay, awesome. I think that was all. So thank you again, Austin, for your presentation.